I think we all want to go to the moon, but if you want to ride the rocket, you got to be prepared to pull the G's.
In 1959, NASA built a machine at the Johnsville Naval Air Development Center. A massive steel arm, 50 feet across, spinning a capsule fast enough to crush a human body. Astronauts didn't need to survive impossible forces. They needed to face 4 to 6 Gs, the force of a Saturn V tearing through the atmosphere. They described it as an elephant on the chest, vision narrowing, breath becoming work. The centrifuge measured one thing: how humans behave under extreme pressure. Some showed up prepared. They'd memorized the protocols, trained their bodies, understood the physics. When the G's climbed, it still hurt, but they weren't surprised. They saw the centrifuge as the price of admission. Others arrived on enthusiasm alone, dreaming of glory, of spaceflight, of the destination. But when the machine spun up and their bodies instantly weighed hundreds of pounds, panic took over. Many hit the kill switch. Others pushed through once, then quietly quit. And then there were the test pilots. They came for the machine itself. They asked engineers to push it harder. Some found the limits of human endurance. Others washed out, chasing the rush instead of the mission. Today, that centrifuge has a new home, the modern financial markets. And nowhere are the G-forces stronger than in Bitcoin. Bitcoin sits at the crossroads of technology, monetary policy, and global demographics. It's a fixed supply asset with growing institutional adoption, stronger network effects, and a macro backdrop defined by record deficits and currency debasement. With a market cap near $2 trillion, Bitcoin is largely held by 3 dominant investor archetypes. 1. The long-term believers. These are the astronauts who trained for the Gs. They understand Bitcoin's fundamentals: fixed supply, decentralization, predictable issuance, global portability. They welcome volatility. Every drawdown is an opportunity. Every cycle is just another rotation of the centrifuge. Their conviction strengthens as adoption grows, technology improves, and the macro picture deteriorates. They're not selling for years, some not for decades. 2. The FOMO-driven participants. They see the stars, but not the physics that carve the path. They enter because of explosive price action, price targets, social media hype, the dream of easy wealth. But without understanding the foundations, the halvings, the mining incentives, the supply engineering, every pullback feels like betrayal. Every rally feels like destiny. They live in a loop of euphoria and despair, a cycle of hope and panic. 3. The leverage-driven traders. These are the test pilots. They come for the machine, not the mission. Perpetuals, 100x leverage, zero-day options, they know exactly what they're signing up for. Sudden 30% drawdowns, waterfall liquidations, OGs unloading billions, macro whiplash. Their time horizon is measured in hours, not years. Some thrive. Most get thrown from the centrifuge. Of course, there are others: institutional allocators, miners, corporates, sovereigns. They matter enormously. But by number, the 3 behavioral types dominate. And that leads to the real question. Which one are you? Which one do you want to be? And what would it take to become that version of yourself? Because markets don't reward people who don't know what game they're playing.